Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through the comment section. I'll give you my opinion on some of the comments and questions that you guys put in the comment section. The first one is curious as to what you think of the chart for Corsa coal. Do you see a wedge forming, and does this look like it will break to the upside or downside? So I pulled up Corsa coal. Here it is. What I see is a declining trend line. And we went to break out and we got rejected. And we're right back below it. Doesn't mean it won't go back up. But that's what it looks like there. If you look at it from a non-logarithmic, you can see this thing kind of going on down there. Let's zoom in on this. We've got the volume stepping up on the right-hand side. We've got nice big buying pressure here and then the slow leak off of sellers all the way down. I don't know. It doesn't look bad from a technical perspective. Here's I'm zoomed in here on a yearly. These are daily candlesticks. So this one that I was looking at was monthly candlesticks. These are monthly candlesticks. You can see how this thing is moving. It doesn't look horrible. On a yearly, you got that same type of movement where you get a nice good impulse move higher and then the slow leak off of sellers here. It doesn't look horrible right where it's at. At least that's my opinion there. Coming on down. There's some people trying to explain all the moves. In all the news, guys, I don't really. News is news. It's not the structural underlying beneath this. The medical event in 2020 that everybody went through, where they stopped the economy. All of the same things that were going to do well did well. They blew up kind of the last part of that bubble because interest rates went down. So everybody kind of piled into technology stocks. And I think that was the last hurrah before going lower. That's what I think. But even if you try to inflate debts away, that is fine, but you still have to pay the debt. And unlike the Fed, we cannot print the money. We have to earn it. And at this point, wages are not going up at the same rate as everything else. No. Well, the design of the system has the federal, everyone. So the way this system is designed, when a dollar gets loaned into existence, everything gets loaned into existence. There's interest tied to that loan. But the money doesn't exist for the interest to be paid back. So the only way that the system can exist is if they infinitely blow this thing up. Notice that every single country that has a Federal Reserve is all in debt, all of them. How is that possible? Well, it's by design of the system. You can't all be massively in debt unless it's the design of the system. I mean, wouldn't you think that we'd have some nations be creditor nations, some be debtors, so on and so forth, and they're all massively in debt. And the way that you survive in these systems is you have to, at some points, inflate like no other, just in order to survive. It's at the end of the system, or at the end of that design of the money system. So the way that you would want to do it, and I'm not saying that you should do this, I'm not doing it, but is if those who align themselves with the debt holders, if they're going to inflate the debt away, that means you're going to have very high inflation in those systems. I mean, the way that some of these people have basically had hyperinflations is their currency, they inflated their currency at a far greater rate than all the other currencies because it's a relativity game. It's all relative. So if the dollar is going to maintain value in its index, well, that's relative to other currencies. And if everyone's printing like mad, well, then it's just a relative game. If you don't want your currency to die, and you could have massive worldwide inflation, which we have, so it's all a relative game on an index. But on an absolute value terms and in terms of the way the system is designed, I would not be saving dollars. There's no value in dollars. I mean, in my opinion, all of the value, and you've heard me say this before, is in commodities and converting those commodities to usable products. Businesses are just entities that are there so that people can sue this entity. They don't sue the personal person who owns it. They sue the business or the entity. It's a tax shield and a lawsuit shield. And the business is just a shell. It's just a name or a name of a company that flings commodities through it and collects money. And then there's other things with services and how to become more efficient in technology and all that stuff. More or less, the entire game of everything and all value is created from either the commodity itself or converting that commodity into a usable product. That is also final payment. There is no other thing out there. You can't, I guess you could have a final payment to someone if it was a service of some sort, but you can't have a final payment be in dollars because a dollar is a future repayment. It's debt. It's a promise to pay something back in the future. Nobody wants to accumulate a whole bunch of dollars and then never use them. You want the final product. You want the final experience. You want the final something. So I think all value is commodities and converting those commodities. And businesses, they're only worth something so long that they're spitting commodities out at the back end or whatever service they're providing. There is no value if they stop doing that. For whatever reason. It says maybe real estate inventory grows dramatically soon after rates are raised. Gold is very cheap and so is debt. For some reason, I believe there needs to be a heavy weighting given to debt when making many of these considerations. Maybe the boomers have to die before we can see growth in the housing inventory. So I just look at the inventory. If the inventory is very low, we don't have a housing bubble. It's as simple as that. You can't have no inventory and be in a bubble. It doesn't make sense to me, the arguments that most people have. Now, if whatever they are saying in the future materialize, we would see it in inventory. And if inventory goes up, then I'll change my mind. It's that simple. But with no inventory, you can't make the claim that we are in a bubble with no inventory. That's like saying this car can go 300 miles and you have no gas in the tank. It's like, you can't go 300 miles. There's no gas in this tank. Well, we can get it. We can go buy gas. It's like, well, you don't have gas until you have gas in the tank. If you're going to go buy it, I'm not going to go off of data or people saying that inventory is going to come or the price projection or prediction. What I do is I look at the inventory. Now, this is going to take many, many months or years to resolve itself. So those who think we are in a bubble, well, inventory is just not going to come slamming back. They can use whatever metric they want. Doesn't matter. They could use applications for mortgages or whatever it is. Those aren't the drivers per se. We have to see what the inventory does. And we have to see where housing starts. If housing starts to continue to go up, I don't care. You're going to get inflation. It'll be an inflationary type move. Now, I was talking with somebody and I made a comment that the stimulus was the main reason for the inflation. And I'm right, because they pummeled this with a bunch of stimulus. The housing starts are also behind it with an inflationary push. Now, historically, housing starts have been the driver, in my opinion, of credit expansion and loaning. And there's also other things that go along with people buying homes. Like they need to buy more furniture. They need to put stuff in it. They need to buy whatever. They're in their max spending years because they're starting to have kids and spending on kids and diapers and all this other stuff, XYZ, more food. Velocity kicks up a little bit. It's all tied together, in my opinion, based off of where the demographic is in their spending years. So, and I just lost my train of thought of where I was going with that. So going, it says, hey, Andy, a question about the housing cycle. If we have a property crash, what would be your adjustments to your portfolios? The main reason I asked the question is after watching Stephen Van Meter's new title, The Housing Bubble is About to Burst. He presented opposing views. I don't want to sound clever and pretend to fully understand his case. Would you watch the short 9-minute clip? Guys, there's been people calling for housing bubbles all the way back in 2020. All of them have been wrong. You got to see the inventory go up. I don't care what they base their argument off of. You have to see the inventory go up. And you got to see housing starts fall. If we see the housing starts fall, the volume of it, and when I mean fall, I'm not talking about a 1 month pullback. I'm not talking about, because we're going to have supply chain shortages. We're going to have problems and difficulties closing on homes. I'm talking about a sustained lower move, lower high, lower low, lower high, lower low, going below the average. That is what I mean. If we get that, then you run for the hills. You run for bonds. You run for bonds, you buy bonds, and then you sit in them. And you wait for the crash. You'll have lower interest rates, bonds will get repriced higher, and then you swap over to stocks in a recovery phase of real estate. Problem is, we don't have any homes. There's no homes. I don't care what. You have to see the inventory go up. You can't have homes go down. We are not in a bubble until inventory goes up. Go look at the last cycle. Maybe I'm trying to think if I had, and I'm looking at, here is one thing I've got here is the months of inventory for homes for sale. And you can see the inventory went all the way up to 9.5 months when we had a decline in real estate prices. Then from mid 2011, we've declined the inventory over time. And you can see the cycle. It cycles back and forth because it's seasonal. And you can see it decline. And we're starting to come to a very low level. And then we fell off the back end here. And we're all the way down at like 2 months. You can't have a crash unless you get the inventory. Like, this has to reverse itself and go up. And it might. I'm not saying that I have all the answers here, guys, but it might. And then if I were to look at, let me see if I've got any other a better, bigger picture. And there's Canadian housing starts there. You can see this thing rocketing higher. There's the crash in housing starts. It created another base and broke to the upside. So there's that. And what I'm looking for is so here is the number of existing homes listed for sale. This was back in 2003, 4, 5, 6, 7, 8. You can see this gigantic move higher, up to 4 million. Problem is now is that we are way low. We are lower than the beginning of that move. So we had a nice big move in the number of existing homes listed for sale, and now we're way, way down here. And this is 2021. We are like way down here. We don't have any homes, any active inventory. And it's a trend that's been going since 2010, 2011. It's been declining and declining. Here's the housing inventory graph here. U.S. housing inventory remains at record low levels, months of supply, and we are just scraping the bottom down here. And what that means is you can't have a bubble with this. Those guys are wrong. I'm sorry. They're wrong until this changes. This has to change. You can't have record low inventory of homes and not have home prices remain robust or go up. So whatever metrics they're looking at, I would just discard their entire argument until you see inventory go up. You have plenty of time to make whatever adjustments we need to make by looking at housing starts and inventory. Everything else is not needed to look at. So if I were to go into a bubble, if I were to use the metrics of where would I invest based off of housing starts? Like, what would I use? What would I look at? What are some leading indicators? Housing starts, housing inventory. Those are two things. Everything else, I don't really look at. There's no point. News doesn't matter. A war doesn't matter. A war can impact things, but the structural underlying fundamental conditions will still be there. But this is on a long-term perspective. It's not on a short-term. Long-term. Long term is 10 years. And things can cycle up and down. A war could go up 20, 30, 40% or go down that. But does it mean that that's the structural underlying condition? No, because whatever's happened before it, it's going to happen after it. Things just don't, unless there's a massive war and people really start dying off. I mean, that's a possibility. But, and I don't want any of this to happen. So where can I invest in copper and aluminum? What exchange and what company? Well, I mean, you got to look at the aluminum one. If you want aluminum, check out the nickel copper stuff, guys. But the diversified mining companies are good. VALE, BHP, RIO, NILSY, which is a Russian company, which is down right now. And a lot of this it's going to take some time. The markets go up in impulse moves, and then they pull back, like uranium's going through right now. It doesn't mean that the bull market's over. It just means you have to be patient. You buy the dip, and then you ride it higher again, so long that the market conditions are good, and the ratios are incredibly cheap. So you just stick to that. Everything else, all the news, all the other garbage, you don't need to even look at it. Inventory of real estate, housing starts on real estate, days on the market for real estate, those right there. That's what we look at. If those are still good and interest rates are going up, interest rates it causes the rotation of money. Everything else you don't really even need to look at. It's all just data to have data. And then you look at the ratios to see if they're expensive or cheap. And all these ratios are still on the cheap side. If gold goes higher, then those ratios will remain cheap. They can continue to go up without eating through their valuation. So if gold goes up the same time that oil goes up, and they're going up at roughly the same pace, your ratio is going to be roughly the same, which means your value is not getting sucked out. It's just accounting for inflation. And we've got a good amount of inflation. Now, if things change, you go back and you look. Ratios, housing starts, housing inventory, days on the market. In American currency. Why American currency or US dollars? Because that's what commodities are priced in. That is your denominator. What we're playing is the denominator here, not the numerator. The numerator will go up too. That's your supply-demand balance, and you'll see it in the ratios as it compresses against gold. And that's all you look at. You don't even have to look at anything else. Everything else is unneeded. I mean, you can use it as information, but it's not the final determining factor. If someone says down payments on homes are going down slightly, you're like, okay, like that's not the determining factor. It's not the leading indicator. More people aren't going to be refinancing here. Mortgage people aren't applying for mortgages. So what? Doesn't matter. So what if they're not refinancing in the same quantity as they were when rates were lower? We're looking at housing starts and the volume of housing starts because that's the driver of inflation. If it falls below 1.5 million, we're going to have to start looking at transferring money into bonds. But right now, it's not the case. We're still up. And it's going to cycle and move all over the place. Things don't go straight up. People have problems, supply chain issues, housing start closure problems. I mean, we're going to see all the problems. And this market could be drawn out quite substantially, and prices could go far higher than what most people think because of the shortages slowing down the new housing starts. We can't just ramp it way up. And that will slow down the rate of inflation if inflation comes from housing starts. But it also depends on what they're printing in money in the background, doing all this stimulus and whatever, and how much they bring it back and what they do. It all depends. It says, I've never considered the fact that the invention of cars helped stop the rate of deaths from horse poop vectoring bacterial infections. No wonder why. In America, USA, Canada, whenever we don't agree on something, we spout off it's a bunch of horse crap. It's actually a good practice to take your shoes off before entering the house. There's a good reason why the Japanese do it, and we should learn to do it ourselves. Just saying. It's true. Yeah, the two inventions were plumbing and the cars. That was one of the largest increase in lifespan for humans. Pretty crazy. I got that from a philosophy class, environmental ethics. I went through environmental ethics, and we went through a bunch of philosophical questions that dealt with a whole bunch of different things. It was a pretty interesting class, and we attacked or dove into some things that I didn't really think about, and it was actually ended up being my favorite class of all of college. Was environmental ethics, as weird as it was, and we talked about a lot of financial things in it as well, which I actually liked because I didn't really take too much finance stuff. And that was my last year, my last year of college. I took that. Um, yeah. So the way that I do this is, man, been crushed with Bannerman position. Um, I just continue to cost average in. That's what I would do. Look for a bottom. I don't know if we're at a bottom yet. We'll see. Uh, it looks like some of the uranium companies are trying to put in a bottom. It's about like a smaller percentage than half. But we're seeing what can turn this thing around. I like Bannerman. That's me. I've been in it since day one, and I've cross averaged going up into it. It says Martin Armstrong has a low of 14th of March. I'm fully invested in UR, but will actually use my credit card if it does indeed crash on that day. Keep the 14th in mind, everyone. Well, I don't know if people can call it to the day. I mean, I'm very skeptical of people calling bottoms in general. But what I do is I cost average in. I try my best to get a good, decent price. And then when we go way up, we're probably going to forget about how we're going to look back and say, man, that was really cheap. I should have bought more. It's how it always works. And usually what I do is I buy more. And I don't have that I should have bought more thing. And no one's going to be perfect. You're never going to time your buys perfect. Sometimes these things are so volatile that you can be down 30, 40, 50% quite easily. It's not a big deal. Buy more shares. It's about the number of shares that you own. And obviously you want to get it at the cheapest price. I completely agree with that. That's why you do kind of a cost averaging in strategy when things come down. Never chase a stock. Never chase it when you can chase it right in the beginning, but don't chase it if it's way up there. If you see something with a chart that goes vertical like this, don't chase it. Just wait for it to kind of cycle back, consolidate, and then buy it off the bottom of a pattern, a falling wedge. It doesn't mean that will necessarily 100% of the time go up, but it gives you a higher chance of getting cheaper shares at a good price. That's all. But I'll stop it there, guys. Give me a thumbs up if you guys like the content. Subscribe if you haven't already. And thank you for listening. This is Finding Value.